welcome back to another episode of This Journey to a Payout. So I am trading forex on this new Darwin account, and I won't stop trading until I get a payout. So I want to review what happened since last time. I've been trading since December started. I tried not to trade too much because I didn't want to overtrade. So the highlight of this week is that I lost $240. So I'm going to walk through the trades that led to that, and we'll get right into it. Okay, so here's how my Darwin looks right now. So we're in December. I have a negative 1.87% return and an overall return of 3.39%. In terms of assets and time frames, mostly forex, 94 trades, 45% European session, 20% Asian, 33% American. Yeah, I do really like the European session. I'm also currently ranked around 3,000 out of the almost 7,500 participating. Let's get into the actual trades now. I want to start out with the New Zealand yen because I was expecting an overall bullish move on the daily time frame with this bullish shark pattern. I'm not sure if it actually got down this low, but that's what I was expecting from the daily time frame. So going down to the 1 hour, all of these moves that I was looking at were within that context. So one of the trades I had opened was a buy. So with this buy, there was an area from November. There had been wicks that had teased that area. It was a previous imbalance that had then been filled and wicked back into. What I was expecting was the high of the day from that same date, which was November 28th, to be revisited before price potentially went back down. So I was really hoping, so what I was looking at was a potential retracement, really to get back around these Asian high levels that had kind of just been a bit wicky. With that, I took a buy during the midday of the New York session. Price then went back downward. So this was a pretty significant loss. Now, why was my stop loss so wide? Because of all the bullishness I had seen happen. I was expecting that if price did retrace that low, that it wouldn't get all the way back to where the London to New York session overlap started. But apparently price decided that it did want to go back down, so that was a loss. I just want to go to the 15-minute chart to show that sometimes you just get really good entries in the wrong direction. So in this case, it's like I bought the high of the day, bought the high of the day, and then price went back down. Now, where would it have been smart to exit? Well, let's see. The candles began to break down. Some imbalances forming. Where's the retracement? Well, here's an imbalance that price retraced into. That could have been a nice justification for exiting, I think, but I decided to keep holding. And then again, the same thing happens. Bearish side, so there's imbalance, and then price wicks back into that. That's another area that could have been a good place to exit. So you begin to see these patterns and you begin to identify places where it might be good to kind of get out of the trade instead of being so stubborn. So that was a loss. The second trade then was on Tuesday. So on Tuesday, there was this creeping trend upward, a bit of consolidation. New York session opened, and we continued to see this really tight price action. What I was looking for was an explosive move to the upside, given that we had been going down for quite a while. My previous entry to around this next entry was over 80 pips. So if we were to go back to the upside, considering that this was only Tuesday, then I was thinking that that move was going to be very explosive. Now, I kept the stop loss small to prevent further losses, but what happened here was this continued to chug along downward. I got out with my stop loss being 11 pips below my entry. So then Wednesday happened, a bit of some volatile movement. I stayed out, waited. I saw that we were kind of pushing to the upside. By Thursday, there was a new high around 88.65, which is near some of these previous levels, Asian high in particular. I thought, okay, we're bullish. Let me get in for some buys. Now, this buy I took was actually not the smartest. I kept a very wide stop loss. This triggered during London session, would have been asleep at that time. One thing I wanted to mention was that for the stop loss, and the reason why I kept it so wide was because of this imbalance from Wednesday. I was looking on the 1 hour chart. So this is 15-minute, but on the 1 hour chart, 50% of this area of imbalance I considered that to be the invalidation point. So if price were to go beneath that, I would take that as a sign of bearishness. So I kept this mental stop loss. Price did not get that low. It actually did wick into that imbalance, but it didn't get that low. Tested it twice. After these two tests, the third test was a bit higher, and then, of course, that wick formed. Price continued to move to the upside. All this I was just holding throughout the whole day, looking to see how high price could potentially get. And really the only aim here was to get past this area of imbalance. Eventually price did get there, so I actually was able to get out. That happened during New York session. That was 20 pips there. Overall on NJ, it was pretty tough this week. I think what was the most confusing part about trading NJ this week was the fact that there had been such volatile movement. I looked at some of the sentiment on different websites and it seemed to be pretty bearish. When sentiment reads as bearish for retail traders, the opposite is true in terms of the actual price movement. I was also seeing that there had been a lot of news happening in Asia, and based off of what I was seeing, I would have expected price to be more bearish than it was. But anyway, so here's what happened with pound Aussie last week. On Monday, there was news. The Australian dollar's interest rate stayed consistent with what it was previously, which was like 4.3%. That news happened during Asian session. Initially, I was looking for a sell off of this imbalance before that news had come out. Once that news came out, then I was tapped into that sell. I actually went to work this day, so I was triggered with that sell. I was completely ignoring all this price action, keeping my stop loss pretty high because I wanted to make sure that if there was any type of push upward into that 2 level, that I wasn't going to be triggered and have a loss because of it. But as it turned out, price went way past that level. So by the time I actually got back to the screen, price was around the 2.0050 level, which is 50 pips over where I would have ideally have liked to have gotten out, but I didn't set a stop loss there. So looking deeper at this move and looking more into the price action that I didn't look at the time, there had been a clear bullish intent with some of this upward movement. Look at the trend line there. There's a candle that wicks down into the imbalance. Then price shoots up, another imbalance. Price wicks down back into that imbalance, then shoots upward. It's just the same pattern repeating. Another imbalance. Price shoots up, wicks back down into it. This whole candle could have been a really good profit. This trade here was similar to the other one. Kept the stop loss around the same because I was actually looking at the price action by this point. I was looking for price to get back down past this imbalance into this area where the wick is from this candle on Tuesday around New York session open, but that didn't happen. Look at this huge wick, 2.01. It got that high, wow. Anyway, the next day, because of all this push upward, I was expecting a push downward. Just wondering when that was going to happen. So this imbalance here, price wicked back up into it. I took that as a sign of bearishness to come. With the entry here, I wanted to make sure that the stop loss was wide enough so that if there was any swing unnecessarily high, I wouldn't be stopped out. I kept my eyes on that imbalance. Now, the reason for the entry was this bearish candle, which had been wicking back up into this area of imbalance. So that pattern continues to repeat itself. I saw that. I saw price push downward. I took the sell, set the stop loss high above. Price consolidated a bit and then pushed back downward. Now this push down was past that area of imbalance, all the way down to this 1.9959 level, which is near this last bearish candle before that bullish push upward. That's just a nice way to find targets when you're looking for exiting positions. The whole trend this week was big push, consolidation, big push, consolidation, big push, consolidation, and then the reversal, mirroring the same. Big push, bit of consolidation, and then another big push, more consolidation. With this consolidation, I saw this as a flag pattern, not an ideal one, but still one of sorts. 2 hits on the top, 2 hits on the bottom, and then the decisive move. Zooming in here, I saw these 2 candles, the railroad looking candles, price push up above them, took the sell, saw that as a sign of bearish intention, taking out these highs. Now, I panicked a bit because of all the volatility this week and just exited with almost 12 pips of profit. My actual target was set around 1.9856. Reason being, another wick on the higher time frame, which was on the 1 hour, where I saw this would have been nice to take profit there, but I didn't. I did secure my 12 pips though, and then price continued to consolidate for the rest of Friday. GA and NJ were pretty much the focus this week. I'm going to keep going and see what I can do with the rest of this 3-month allocation. So definitely stay posted for that. Peace out. See you next time.